Well, good morning, everyone, from here in London, and welcome to today's FS Club webinar. Our subject today is the Share Valuation Worked Examples group in the changing valuation landscape. And we have here, of course, William Franklin, who is delighted to come back again. We're delighted to have him back again during these webinars. William has spoken to us on a couple of occasions in the past, and he chairs up the Worked Examples group. And so we're going to learn a lot more about that today. You'll know me, I'm Michael Mainelli. I'm one of the directors of ZN, and it really is my privilege to be able to introduce many of these webinars. And I can only do so thanks to our many sponsors who are kind and generous in allowing us to range widely and freely. And that's not just the FS Club sponsors, but also our Esop Centre sponsors who are capable of delivering all sorts of services to do with employee share ownership, and I'll leave that to you. And Pett Franklin is clearly one of them. Now, today's agenda is going to be a fairly straightforward one. I'm going to get out of your way so that you can hear from our expert, William. And then William's got approximately 25 minutes of presentation material, which is available online as well. The slides are available online, and the recording of today's session will be up in approximately 48 hours. I'll warn you that William's got 3 poll questions to keep you awake out there, but I think you'll find them a little bit more challenging than usual. And so if you don't mind, with no more ado, William, the floor is yours.
Thank you very much, Michael. Many of you hopefully will know me already. I'm a partner and founder of Pett Franklin, which is a share scheme practice, but we also do a lot of work in valuation. And as Michael said, the topic today really is something called the WEG, the Worked Example Group, and where it fits in to what I describe as the changing tax valuation landscape. Next slide. I just want to just briefly say, before we get into this, what is the WEG? What is this Worked Example Group? Well, it's a committee of valuers and advisors in the area of tax valuations of shares in unquoted companies, which also includes HMRC, and in particular the head of the valuation department of HMRC, SAV. It's sponsored by 4 industry groupings that are concerned with share schemes: the Esop Centre, ProShare, the Employee Ownership Association, the EOA, and the Share Plan Lawyers Group, as well as HMRC itself. And the goal of this group is to create more worked examples, with a view that that could help narrow down the range of uncertainty, which can be helpful to everyone. The idea really is to build on those worked examples that are already set out by HMRC in their manuals. So we're not starting from scratch. We do have a history here of revenue themselves doing this, but the idea now is to develop more of these in a collaborative approach. That's the goal. And also what I would call, perhaps loosely, an open source approach. The idea here is this is open to everyone to come forward with new ideas, new worked examples for consideration and potentially inclusion as worked examples to be adopted by HMRC. So that's what this is about. Next slide. I think the reason it matters is because in unquoted companies, for employee share schemes, valuation matters. If an award of shares is being made, then the value of the shares for tax purposes will usually determine how much income tax or employment taxes are payable on the award. So it can have a very direct financial effect. It can also set the value from which an employee benefits from growth in value in the equity. So, a very direct effect on what the employee gets. Government tax-favoured share schemes usually have all sorts of limits, like the EMI 250,000 limit or the SIP limit of 3,200 for free shares, and you need to know whether you're the right side of the boundary. So again, you need, in an unquoted company, a valuation for those purposes. And employee share schemes are just generally a quite important part of the package of incentives that drive growth shares, or rather the growth sector of the economy. You know, areas like fintech and life science make extensive use of employee share schemes, and in unquoted companies, the value of those companies is a sort of critical part of the jigsaw as to whether those share schemes are effective or not. Next slide. So, as Michael said, we're going to have a little bit of audience participation here. And we're actually going to put you a question, which I will ask again later on, by the way. But to begin with, what I want you to imagine is that you were confronted with a whole range of numbers. Now, those numbers might be any numbers you care to choose or think about. And you're asked to decide which is your best estimate of the number that best represents that range of values. You've got to choose a single number to represent that range of values. Which one would you choose as the best estimate of that? I'm giving you three choices. Is it the biggest number, the highest possible potential value in that range? Or would you choose the average of those potential values in that range? Or would you choose the one that occurs most frequently, or most probable value within those range? Which of those do you think you would choose as the best estimate?
Great. So William, the poll's up there now. I'm always stunned at how swiftly the Esop and FS Club members are. Over 50% have voted, over 60%. I'll give it just a few more seconds to let everybody get in there. Great, and I'll now close the poll and show you the results. So number 3, the most probable, William, up there very much at 77% is what people thought.
Right. That is very interesting. As I said, we'll ask you to poll again later on. Next slide, please. So, what's the context? The context for the worked example group. Why does it exist? Well, the tax landscape has been changing over the last generation quite significantly. If you go back to before 1997, tax valuations, I like to characterize them as being like siege warfare. The taxpayer or their advisors and the revenue would usually sort of exchange cases like shells being fired between the lines in the First World War to defend a particular position. And because case law is something, you can usually find something to defend, to justify your position somewhere in it, that often led to very protracted discussions that meant that valuations, where there was a dispute between the revenue and the taxpayer, went on for a very long time with very little ground gained frequently. That was really a hopeless environment to encourage the use of employee share schemes. And after 1997, we saw the introduction by the government of the EMI scheme, which was intended to be used for unquoted companies. So something had to be done to change that climate. And it was. I mean, the government encouraged HMRC to adopt a much more commercial approach to the valuation of unquoted shares when they were being used for employee share schemes. And agreement procedures whereby taxpayers could go up to the revenue in advance and seek confirmation or not of the value of the shares. These agreement procedures were encouraged. It was all part of a philosophy of the then Chancellor of the Exchequer, Gordon Brown, that taxpayers should at least have certainty as to how much they would pay. And obviously in share schemes, the value of the shares is a key component in giving you certainty. Something else that affected the landscape, which was more sort of accidental, which was, and this is a particular feature of the UK, was that if you go back 2 generations to 1982, there was, in those days, a general rebasing election, whereby people were allowed to reset the value of assets they owned to their March 1982 value and ignore the history before then. It was a great simplifying measure. Yeah. But in terms of shares, unquoted companies, the revenue were very happy in those days to encourage large discounts for the fact that shares in unquoted companies, when they were minority holdings, arguably had a very low value because of the difficulty of achieving any marketability. And so a culture grew up of very large discounts, 70, 80, 90%, even more. Now that was for March 82, but the principles carried on into the future. So we had, after 97, what one might almost describe as a golden age of valuation, where we were able, with the help of the revenue, to agree values, give certainty to taxpayers, and very often, because of these large discounts that were permitted, often really quite modest values were agreed, which was helpful in terms of encouraging employee share schemes, because it meant that more awards could be made within the limits, and employees could benefit from a lower initial value and therefore receive more potential gain in a tax efficient way. Then things really started to get a bit out of hand. I'm calling it overreach. And this manifested itself in a non-government scheme for growth shares. Remember, growth shares are the idea where you create a new class of shares which gives the holder of those shares the right to the growth in value above a threshold. So they're a different kind of ordinary share. You don't get the whole value, you get growth above a threshold. They became, in the last 10 years or so, widely used for larger unquoted companies. And they were massively encouraged by what I would have to describe as a huge mistake by the then government, with the introduction of something called the Employee Shareholder Status Scheme. This is now in the past, but awards that were made under this scheme still exist. And the way it was structured was it encouraged companies to set up growth shares to fit within the rules. It led to a huge diversion of HMRC resources agreeing these valuations. And once, eventually, when there was a change of Chancellor of the Exchequer and Osborne was replaced by Hammond, about the first thing he did was to get rid of this scheme. But also, what unfortunately happened was the huge diversion of HMRC resources in trying to agree these growth share valuations meant that the revenue also abandoned the other arrangements that had been created in the past for agreeing the valuations of unquoted shares, at least the ones that were not within government-approved tax schemes. So these arrangements for agreeing values still exist for things like EMI, but a major cloud now hangs over them. Because the revenue have shifted their resources. They're no longer seeing themselves as providing a public service duty of helping people obtain certainty as to their tax payable. They see their role very much more in filling the tax gap, a very different purpose to valuation from the revenue's point of view. Next slide, please. So we moved to a regime where instead of being able to go to the revenue in advance and agree values, the revenue now can look back afterwards. Fundamental change. And that means that a lot of the uncertainties that exist over how you should value shares are becoming more acute. There are really quite widely divergent views around how you value growth shares, for example, or development companies, how you deal with discounts, and the whole basis of what information you take into account when valuing an unquoted share is also something now where there is a lot of uncertainty as to what is correct. Valuers outside of the revenue have one view, but HMRC increasingly take a different view. So this is the combination of look-back reviews and uncertainty is creating problems. Next slide, please. So the role of the WEG is to try and do something about this. One of the consequences of losing these valuation agreement procedures is that the dialogue that used to take place between valuers and taxpayers and the revenue has disappeared. So We're trying to fill that lack of feedback with the worked example group. We're trying to narrow down uncertainty and encourage, in an atmosphere where there is disagreement, a more collaborative approach. So the role of the WEG is to act as a sort of buffer and a filter. The revenue are not going to go back to allowing backdoor PTVCs. That's not the purpose. But the WEG is to try and filter out ideas that people have as to the way things should be valued, with the hope that the revenue will then adopt the good ones as worked examples that can be generally used by other people as well. Next slide. Now, two of the areas the WEG has already addressed concern valuations where we are looking at new ownership structures. There's been, in the area of community interest companies, that's CICs, a worked example that sought to describe how you would value shares owned by such businesses. And then another area where we've had a worked example issued is in looking for EOTs, employee-owned trust companies. This is the sort of John Lewis style trust-owned companies. Now, these do represent a different type of capitalism in some respects, and they raise quite profound questions as to how you should value shares in unquoted companies with that ownership structure. So one of the outputs of the worked example so far has been to sort of address these particular issues. Taking EOTs, for example, the next slide. There's a worked example called Pamela, which seeks to address how you should value shares in unquoted companies that are owned by EOTs. You can see there, I'm not going to go into the details, but you can see the sort of style of a worked example. Quite a lot of it is narrative. Quite a lot of it is about telling a story. But hidden within that, or not hidden within it, in plain view, are quite key ideas that you can distill from them as to how you should value a company in that situation. And that, if you like, is the sort of model that we're working to for other worked examples. By the way, there is a website for the worked example group which can be accessed. It's been updated recently. Like so much else, the worked example group has been affected by COVID. We had to stop having meetings, and we had to cancel what was going to be the main launch of the worked example group at the Revenue Zone Fiscal Forum, which is an annual event the Revenue host on share valuation. Because of COVID in March, that was cancelled. Hopefully one day when we are able to do this again, it will be an opportunity to launch the WEG more formally will occur. But that has not stopped us working already, as you can see. And it is available for use already. Next slide, please. Just want to mention a couple of projects that we currently have on, all of which are very challenging. I've mentioned growth shares, where there is a wide divergence of view as to how you should value growth shares. Difficult subject. The recent OTS report commented on how difficult it is to value growth shares. And there certainly is a wide range of views as to how you should do this. Another area we've been wrestling with is internally funded market makers. How do you value shares in an unquoted company where you haven't got external purchasers, but you've got things like an EBT or the company itself acting as an internally funded market maker? So you have transactions potentially, but are they market value? Very challenging issues there, but increasingly important subject. But the issue that has given us the greatest, we've had to spend most of our time on in the last year, concerns development companies. Now, what do I mean by development company? I mean a company that is seeking to develop a new product, a new service, and enter a new market, or rather create a new market, maybe, that has a lot of upfront costs, but doesn't have any revenue to speak of, maybe no revenue at all, and certainly no profits, which is funded by the shareholders, by the company issuing shares to shareholders in order to that money being used to fund its activities. That's what we mean by development companies. So how do you value those is one of the most demanding challenges we face at the moment, where there is certainly a considerable divergence of opinion, it appears, between HMRC and a lot of people in the valuation community. Next slide. Which brings us back to that quiz question, because there's a fundamental conflict actually that this issue of development companies sort of brings out. Tax valuations are rooted ultimately in statute, sections 272 and 273 of the capital gains tax legislation, where that introduces the concept that the taxable market value is the price at which a willing buyer and a willing seller would exchange a package of shares between them. But that only takes you so far. What's happened over decades, of course, is case law trying to flesh out how you apply that. And of course, in addition to that, HMRC practice and the practice of practitioners as well have sought to sort of try and work out how you do that. Now, with the withdrawal of the various agreement procedures, the Revenue have increasingly been saying that taxpayers themselves obviously have to form their own view. And within the tax legislation, for share awards which are subject to employment taxes, there's often a requirement to calculate the value for PAYE purposes. And within the PAYE code, there is a concept of best estimate, the directors being required to form a best estimate of the market value of the share when it's awarded in order to operate PAYE. And Revenue have been inclined to increasingly say that if directors arrive at a best estimate value themselves, and they do it properly, and they took care and thought about it, then that value actually, although it's only for PAYE purposes and is only a best estimate, actually might be rather difficult to dislodge for other purposes as well. So the meaning of best estimate is starting to become rather central, and to some extent potentially starting to displace all of that accumulated wisdom built up by case law and practice. But case law does have something to say about this. Because if you look at some of the cases, there was a case about 25 years ago when one of the most eminent of all the members of the House of Lords, now the Supreme Court, Lord Hoffman, gave his views on how you should interpret the market value of a share. And he seemed to be suggesting that a best estimate might be the highest possible value. Now, this is comments by judges in particular cases. But if you follow that line of reasoning, you would be selecting as a best estimate, the directors would be selecting as a best estimate what is statistically an outlier, an extreme outcome in a range of potential values. Is that correct? Is that really what is meant? Is that what the Revenue mean by a best estimate? Or do they mean average or most probable? So, with that in mind, perhaps we could have that poll again, Michael.
Most certainly, William. Just let me pull that up, folks. So you're going to see the same poll again. I'm just launching it now. And folks are filling it in. William, we're yet again over the 50% mark now. Give it just a few more seconds. Fantastic. I'm just about to close the poll. And just give me a moment to present the results. There we go. Well, you've swayed the audience quite a bit, actually. Just as a reminder, number 2, the average was 20% the last time, as opposed to 37%. And number 3 was 77%, now down to 57%. So
that is interesting. It is interesting. I mean, what I find most striking is that the concept of the highest potential value is doesn't find much favour, and yet if you follow case law, which we supposedly are supposed to be guided by, that is where you might end up. But I think common sense suggests that in most circumstances it probably isn't the best estimate, and probably isn't what HMRC themselves think it ought to mean. Anyway, thank you very much for your input, because I'm going to keep that, I think, and I think it's a sort of, I think it has got some relevance actually for this slightly tangled question of what does best estimate really mean. Can we move on to the next slide, which is, again, back to the subject a bit of development companies. Remember I said that you are, under section 272.273, looking at the price at which a willing buyer and a willing seller exchange a bunch of shares. Now, that could be a large number of shares or it could be a small number. That goes to the question of whether it's marketable or not to some extent in the normal context. So let's go back to development companies. Development companies, as I say, fund their activities by issuing shares. So they fairly regularly have events where they get shareholders to subscribe at a particular price for those shares. Now, there can be questions as to whether the actual legal rights of shares in this situation differ, because you can have different classes of shares and they can have different legal rights. But in reality, very often a development company will either succeed or fail. It'll have a binary outcome. So some of the legal rights can be a little bit academic. They will either mean, all the shares will benefit or all of them will fail. That's a bit extreme, but that is generally the view HMRC take. So the question, I think, is the price at which shares are issued by an unquoted company to fund its activity the same thing as the market value of the shares for tax purposes? The revenue generally think it is. They think it's a good proxy. And the problem is, what else do you use? Because if the business isn't making any profits and hasn't got any sales, and obviously its balance sheet will be determined by how much cash it's got or how much it's spent, there isn't really much in the normal way of valuing shares to latch onto. But you do have a transaction. And so it seems quite natural to use that as the basis for determining the value of the shares for other purposes. But is it a good proxy? And should adjustments or discounts be needed to reflect differences that might have arisen? So if I can just turn to the next question. So think about this in the context of an unquoted development company. And the question is the price at which shares are issued by an unquoted development company to fund its continuing activities, to develop new products and markets, likely, without any adjustment, and that's the crucial bit, without any adjustment, to be the same value that a willing buyer and a willing seller would exchange between them a small number of shares?
Okay, I'll just look at that poll. Okay. Questions are definitely getting tougher, but the audience is still swift. Just up to the 50% mark now. Okay, and over 3/4 have voted, and I will just pull that up. Oh, well over 80% now. And just sharing the result, the answer is a very clear, nearly 70% saying no.
Right. Well, that, again, is very interesting. Very interesting indeed. So I thank you, actually, everyone who's voted for that, because that is something I will seek to feed into our deliberations about the valuation of development companies. I think I've done my time, haven't I? 25 minutes. I finished on time, and it's now over to questions.
Spot on, William. Great. Well, folks, please do use the GoToWebinar question facility to send me questions that I can feed in to William. But William, just to get cracking here, quite a few questions. Ian, out in West London, is really kind of curious here about how much this represents ranges, and that part of the problem is that HMRC is seeking a specific point at a specific moment in time. And as you said, you've got this range of possibilities ranging from low to high to average to probable, which are all very, very different estimates. Is there any way that ranges could be brought into this type of work?
Well, I think that's an extremely good question. I mean, the problem is that the tax legislation works off specific numbers. It assumes that there is a single value, which is the market value at any one time. Now, when there is a transaction, when in a quoted market, there is a price at every, whenever a transaction occurs, there is a definitive price, and that is the market value. But in unquoted companies, what you have to do is work out a theoretical value, and you have to sort of simulate the market. And the reality is that when you do that sort of valuation exercise, there is always going to be a range of values. There's always going to be a spread. But the tax legislation forces you into selecting a one number from within that spread. I mean, mathematically, it's nonsensical. But it's one of these examples where law or tax, in seeking to be very, very narrow in what you're asked to produce, is in conflict with actual mathematical and just common sense, really. And part of the reason we say valuation is an art, not a science, is you have to sort of just find a way of managing that inherent conflict and end up selecting a number.
I can tell that Ian does a lot of valuations, because he's pointing out here that option theory, which is used, 4 options, encapsulates the range in its very calculation, whereas these straightforward share price ones don't. Another comment from Elizabeth in East London, happen to know where both of them live. She's curious about how much there's a paradox here of motivation, that the directors, for example, want to give you something that appears very valuable. Otherwise, why were they giving you shares in the first place? HMRC would clearly, at least in the sense of trying to gain tax, like to have you have that valued very highly. You, as a recipient, clearly wish to have low tax. And as you point out, development companies in particular, which we all want people to invest in SMEs, growth and innovation, are impeded if this becomes a high amount of obligation. Can you see any way through this apparent paradox, or is there no paradox at all?
Well, I'm sure that I think a paradox is a good way of describing it. I think there is conflicting positions, really. I mean, very often what the employee is actually getting is the opportunity to benefit from growth. So, generally speaking, the employee's interests will be best served by having as low a value as possible, because that maximizes the number of awards that are permitted within the limits, and it also means that the point from which they start to benefit, if they're getting growth, essentially, is as low as possible. So they will be pushing in that direction. Of course, there is a conflict here, which is with the other shareholders, the existing shareholders, because if the value is too low, they are actually effectively giving away some of the existing value to employees. So there's a tension there between the owners of the company and the employees. Yeah. And I think we often tend to overlook the fact that what's going on with equity incentives is a commercial bargain between the owners and the employees. The owners are saying, if we give you an equity interest, we're doing so in order to grow the pie, if you like, the value of the company by doing that, or at least that's why we believe we're doing it. Do we need to give some of that existing value to the employees to do that? Is that fair? Is that right? And you get to situations, I think, whereby employees have one set of expectations and the owners have a different one. And of course, HMRC in some senses, in terms of the taxation of all this, sit in the middle.
Mm.
So it's complicated. I think there's an eternal paradox almost going on.
Well, as I've been on 4 AIM boards, and the whole point of being on AIM was to get things going. One was a genuine startup with huge amounts of risk, and the other 3 were exploration companies, which are fall completely into your development diagram. And I must say, we constantly faced these tensions. And I don't think enough has been made in a further company. It was this bit about looking back, where HMRC, having agreed to things up front, suddenly turned around and reevaluated them. And that caused us personally no amount of litigation to prove that nothing had changed, just HMRC had agreed it and now wanted to change its mind, which was extremely difficult.
Well, now it's got significantly worse, as I said, because in the past you might have had agreements, and that meant you just say, if HMRC changed their mind, or it's a bit difficult for them. Not impossible, because they can always say, maybe we weren't told all the facts. But we now have moved to a different world where, the touch point with the revenue will be in the future with look-back reviews. Now, we haven't discussed the whole issue of hindsight. In tax valuations, the scope for hindsight that should be used by the revenue is quite limited. But it's not nil. It's not. People assume that there's no relevance for hindsight, and that's not true, because at the very least, in a look-back review system, hindsight will be used in selecting those cases which get looked at.
Got a few questions here, if I can tackle them quickly. One, just any comment on the .com era during all of this?
The .com era, you mean when...
That was characterized by, you could say there was a huge valuation, but the probability was low.
Yes, I mean, it turned out that many of those .coms were not worth very much, and yet they're so. But this comes back to hindsight in a way, doesn't it? Which is that, it is quite likely that companies that don't turn out to have much value will not get their valuation scrutinised, because coming back to what is the revenue about now, it's about filling the tax gap. There's no mileage in them looking at those sort of situations. The situations they will look at are those, and this is the interest of, the taxpayer getting the money in, will be those which have done well, the .coms which have done well. So I think one can only take limited comfort from the .com experience. I mean, it's a good debating point, but as I said, it's the shifting tax landscape that matters, the reality that we have moved from the Gordon Brown era of giving you certainty up front, going to the revenue, public service role of the revenue, helping with that, to a quite different role, which is filling the tax gap.
Where do voting rights fit into these valuations? Is another question from Mike up in Leicester.
Yes, I mean, traditionally, valuers and very often lawyers have often sort of sought to attribute quite a lot of significance to voting rights. I mean, I think there's a problem. I think voting rights do matter. So I'm not saying they have no significance, but if you are in the happy position of the revenue still giving you a large discount for the fact that the shares are small minority holdings, because they are small minority holdings, and they are therefore not marketable in an unquoted company, then it's a bit difficult to say that the voting rights really matter very much, because you're already getting a discount for that factor. So I think, small holdings, okay, you've got voting rights or they've not got voting rights. In reality, they don't have much power either way.
And I've got 2 more questions quickly. One is strategic shareholdings. This is from Linda. The point she's making is kind of a lengthy one. I'll try and summarize it. I think what Linda's driving at here is that sometimes a strategic shareholding can be a very small shareholding. Take an example that decided to give a celebrity some shares because their affiliation with the company would be quite good. How does that potentially affect these valuation issues?
That's an interesting question, and I mean it's not one that the WEG have actually considered recently. So I mean, what I would encourage Linda to do is, if she's got some thoughts on that herself, why not come forward with a worked example and we'll consider it.
Okay. And then a couple more. Chris Prout is curious, what sort of valuation methodologies are you seeing being accepted by HMRC?
Well, I think that's a bit of a sort of a bit of a broad question. I mean, I think you still get valuations agreed up front for EMI options, potentially for CSOB options and SIPs and SAYE. They rarely have SAYE in unquoted companies. So the main area where you see valuations agreed with the revenue now is through EMI. Got to be rather careful here, because the revenue always like to say, whenever they agree on EMI valuation, that this is solely for the purposes of EMI. And when people submit valuations for EMI, there's a form now you have to complete where they ask a number of binary questions, like, is the company going to be sold? Is there a possibility of a float or an IPO? Now, the problem is that if you tick the box that says, yes, there is a possibility, you get a different kind of treatment within the revenue. You get the valuation looked at. Well, if you tick the box that says no, these things very often go through on the nod. But the question that you then have to ask yourself is, if subsequently there is, within not too distant future, an IPO or a sale, and most very often share schemes are set up with the view that there will be an exit event. How reliant can you put any agreement anyway where you've ticked that box? So I think that's the first point I'd make. In terms of look back reviews, you've got to remember this system of look back reviews is only really now starting to kick in. The PTVC procedure, the best estimate procedure, where they've got agreements, carried on until about 3 years ago. So, this review process of selecting cases, which people are only just beginning to see how that's working.
Well, a good closing question here from Mike Wardle. William, what one change to the arrangements would you encourage HMRC to consider to make the system work better?
One change to make the system work better. I think the best estimate system, part of that is also linked to the individual tax returns that people make. It's complicated. What happened is, when they took away the agreement procedures, they said, well, the way to deal with this now is through people making on their personal tax returns. They should declare share awards they've received and the basis of valuation and notify the revenue through their personal tax returns, and then that process could kick in for them to choose to review them. I think one of the things that's been lost with doing away with these agreements that the company used to obtain for people is the ability to get collective agreements. I mean, this system of individuals submitting their own tax returns and then each particular tax inspector, potentially or not, choosing that case for review, you can see how potentially that is a chaotic system. And so I think some system which allowed companies to trigger a process whereby, even if it's not any longer in advance or quickly, a process whereby the review takes place within a reasonable period of time if it's going to happen. And there is a very clear process that you go through. Because at the moment, people don't really know quite what they should put on their tax returns. The revenue have never actually specified clearly what their expectations are. There isn't a spot on the tax returns for this. You have to use the white space or additional disclosure. But if you don't do that, the clock isn't ticking, because the way the system should work is that if you make full disclosure, after a period of time, it is by de facto agreed. But if you haven't entered the information, the clock never begins. And there isn't at the moment clear guidance as to what you should put down.
Interesting. Well, William, thank you very, very much. If you'll just permit me, I've got a couple rounds of thanks and come back to you. So my first round of thanks is very much to our sponsors. I'm absolutely delighted that we're allowed to explore these topics, and this one has been one at great depth. Folks, a reminder that there are quite a few resources available at the Esop Centre, which will be touching on these issues, and we are very proud to be one of the 4 sponsors of the Worked Examples group, and up there as well as, of course, the website that William referenced. We do, of course, have the monthly newspad. Please do have a good look at that, and also a wide range of bulletins. May I thank you, the audience, for your questions and comments during this, which have been fed in. And a reminder that we've got a particularly busy period coming forward with a whole number of events, starting tomorrow with a very intriguing look at parametric insurance, one of the new areas, followed by MasterCard and identity, looking at data privacy. On Friday, we're delighted to have Nick Robbins, who is a leading light in the entire climate change debate, looking very much at net zero finance, but also COP26 and a whole host of things, as ever, on the website. But the real person I need to thank is you, William. I believe this is your 3rd appearance with us, so you're aware that I'm unable to open the audience floodgates of applause, but I do have my Korean karmic clapper. And so this is my ersatz audience clapping. But can I thank you so much for taking the time today, and we hope to have you back on this and many other issues. Thank you.
That's very kind of you, Michael. Very nice to speak.